Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in. We're going to take a look and see what people are sharing. If you want to follow me at Finance Square Finance, and if you want to join our community, finding-value.com is where I dive deeper into all these topics, looking for potential investment opportunities. We're going to start with Daniel, and he's got the 8 investing rules and lessons by Monish Pabrai. And Monish is a billionaire. He learned a lot from Charlie Munger and Warren Buffett. I think he is someone who paid a bunch of money to eat lunch with them and eventually became friends. He's a guy that I follow, and I think he's incredibly good as an investor. I like a lot of his lessons that he's learned and a lot of the things that he has spoke and teaches on YouTube even. So here's 8 investing rules by Monish. He says, rapidly changing industries. As an investor, you need to be able to judge a company's longer term outlook, not precisely, but roughly. In rapidly changing industries, that's impossible. The market leader today could be bankrupt tomorrow. I agree with that, and I avoid rapidly changing industries. I don't have a ton of money in technology companies that rapidly change. I'm in stuff that's pretty boring, and I'm in stuff that I can see is growing and has grown for a while. To give you an example, a company would be MasterCard. I've been an investor in MasterCard since it went public and Visa. And then recently I swapped it over to some of these commodity opportunities. But that's something that doesn't change very rapid, and everyone uses credit cards everywhere I see. So I combine kind of these guys' lessons with Peter Lynch approach. Number 2, you make money waiting. You don't make money by selling stocks. The money in the stock market is earned by waiting. Buy right and sit tight. It's simple. But many people find the right stocks, they just don't hold on to them long enough. That is something that I am a victim of. I did not hold some of my stocks when I was a younger investor long enough, and I have learned that lesson. I've learned it, a very good lesson there. 3, buy the copy. The best stories are told about the big innovations, but history shows that the innovators often die quickly. The best copy is the one that survives. We might find this unfair, but often that's the reality of business. Number 4 is entrepreneurs. Investors and entrepreneurs are not that different. In fact, they need money. They may or say they need money of the same qualities. They have to manage risk and focus on fundamentals. They're just more concentrated than most investors. Number 5 is outstanding opportunities. The best investing opportunities are easy to spot, though not easy to find. They will be so obvious that you don't need much time dissecting them. Thus, look through as many companies as possible, but don't spend too much time on each company. And I think that's where people also kind of they have problems. They dive way too deep into the fundamentals of each of these companies, getting through the weeds. It should be pretty obvious. When I was looking at companies in the bottom of the oil market, I was just perplexed at how cheap those opportunities were in relationship to the cash flow generation potential on the infrastructure that they had. Number 6, keep it simple. Investing doesn't have to be complex. In fact, good investing shouldn't be complex. Focus on fundamentals, assess the risks, and if you don't understand it, move on. Number 7 is growth. Growth is important for the business and you as an investor. Forget categories like value or growth investing. A good company has both value and growth. They're part of the same equation. Number 8, learn from the greatest. Monish has been very close to Charlie Munger. They were friends, and Munger was also a mentor. You and I didn't know Munger, and we don't know Buffett either, but there are thousands of hours of material from them. Use it. So those are the 8 investing principles by Monish. Eddie Goodwill. He says, rich client insisted on maintaining a huge position in Parex. Nothing but good things to say, inside track to management, solid cash flow, share buybacks, large insider ownership, etc. Then all of a sudden, millions of dollars were lost in a day, down 47% this year and dropped 25% in the last 2 days. Stop being fooled into thinking your individual stock pick that is way oversized in your portfolio for some reason deserves more credit than a stable, consistent allocation to the S&P 500. If you're going to pick stocks, sizing is incredibly important. Don't bet the farm. Of course, if you want to beat the market, you have to be different than the market. That means having conviction and taking some outsized risks. But keeping 50% of your net worth in a single stock is nothing but gambling, and greed can destroy your future. Imagine being in your late 50s after making hay the last 20 years, and then poof, it's gone. Feel very sad and bad for this person. Fair warning to everyone else. So I'm not talking about Parex. I know Parex has been a pretty rough investment here, and I have no association or affiliation with Parex. I'm not involved with it at all. But always think about position sizing and how much money you want to put at risk. It doesn't matter the company. Parex, when you look at its chart, it is rolling over. People have asked me about this company because Calvin Froge is basically likes the company. And I looked at the chart and I said, no, I just don't like it. I'm not going to get involved with it. So I didn't get involved with it. Not saying that that this type of trading hasn't impacted me in the past. I just didn't like the chart pattern and what it looked like. And a lot of people do talk about share buybacks and large insider ownership, and I think those are all good things. I just didn't like what I saw in the charts. It looked like distribution to me. And again, here's Parex resources. And the reason for the big sell-off, if you guys want to know the big reason, it has revised down guidance for 2024 substantially. Production guidance down to 49,000 barrels of oil equivalent per day from 57,000 barrels of oil equivalent per day. CapEx guidance moved down to 380 million from 410 million, updated the completion table. So that is where it is. And I know a lot of people got sucked into this thing thinking that it is super cheap. But whenever you see these large selling pressure days and then you don't get a big buying pressure move, that's generally a bearish formation. I don't think that something like this is going to bounce very quickly. I think it's going to take time. And I just wouldn't get involved in it right now. It hasn't based out, it hasn't bottomed, it's got some work to do. And there's other companies that look like this company, the patterns do, that I am not involved in, that people continually ask me about. That's all I'll say there. Inflationary recessions create monetary illusions. Inflationary recessions and monetary illusions. I also think it makes it more difficult to know how some asset classes are going to behave. For instance, look at oil. Oil is very inflationary sensitive. But when you think about recession, you think demand destruction. So you think inflation plus demand destruction, how is oil going to behave? And it's like, I don't really know. It's a really tough situation to be put under because you've got maybe potentially demand destruction, but it's going to be inflationary. And oil is one of the most inflationary sensitive assets. Another thing to look at is on the supply side of oil, I think it's going to be pretty tight coming up over the next few years. Pretty difficult call here to see what is going to be right in the short term. Longer term, yeah, I'm a huge oil bull. So what does an inflationary depression look like? This is from Dollar General earnings call. And you know what? I feel for the people that they are talking about because I also feel it too in my day-to-day purchases. It says the majority of them state that they feel worse off financially than they were 6 months ago as higher prices, softer employment levels, and increased borrowing costs have negatively impacted low-income consumer incentives. As a result, our core customer, who contributes approximately 60% of our overall sales, comes predominantly from households earning less than $35,000 annually. Inflation has continued to negatively impact these households, with more than 60% claiming that they have had to sacrifice on purchases of basic necessities due to the higher cost of those items. In addition to paying more for expenses such as rent, utilities, and healthcare, more of our customers report that they are now resorting to using credit cards for basic household needs, and approximately 30% have at least one credit card that has reached its limit. And in our latest survey, 25% of our customers surveyed noted that they anticipated missing a bill payment in the future. So that's what I guess an inflationary depression looks like. Every time I go to the store, I'm just amazed at how much more I'm spending on the same goods that I've purchased all my life. It's pretty annoying, to be honest. Or how they shrunk the damn packages. TrendSpider, potential bear flag setups with relative performance indicator making lower lows. Do not touch this on the long side, in his opinion. This is Google with the stair-stepping lower patterns, bear flags. And that is, the setups over in technology are all looking like that. They really are. Here's another one from Stan Weinstein discussing how stocks tend to bottom on gloom and doom, and they top on glowing earnings reports. It sounds a lot like NVIDIA. This is Stan Weinstein's opinion here. It says, now, do you get the idea? There's a reason why savvy market professionals know that you buy on the bad news and sell on the good news. Stocks from bottoms when the current news is terrible, and they top out when the public is ecstatic about glowing earnings reports, stock splits, and so on. So they sell, basically they buy the rumor, sell the news. And then if you're looking at it from a longer term perspective, you buy when the fear is maxed out and the news is the worst. That's what bottoms look like. You sell when everyone is ecstatic and the news is really good. That's also going to be the case in the commodity bull market at its peak out in the future. It's always about selling into that public strength, where the public is very optimistic about it. Here's Breakwave, and he's talking about rates. The Libyan crude exports move predominantly on Aframaxes, making up roughly a quarter of all Mediterranean Aframax liftings, roughly 45 a month. The loss of Libyan cargoes is already negatively impacting Aframax freight rates, off another $1,200 a day yesterday for cross-Med voyages, according to Bramer. So this is Libyan crude output export. You can see it's down quite a bit in the short term because of the reduced output from Libya, just an FYI. Structural supply deficit, here we go again. So low capex, no supply. Structural supply deficit is coming to oil. That's what I'm seeing there. This is a really tough call in the short term because you've got a potential recession that could destroy, quote, demand, even though demand doesn't really get destroyed all that much. But I'll call it financial demand. And then you've got this low capex, no supply stuff going on the supply side. Really weird, really good setup for oil if the demand remains stable. Morgan Housel knows the best Warren Buffett stories. Here's one about patience and leverage from his recent appearance on the Behind the Memo podcast. So they're talking about, so if you go back to the 1960s in Omaha, there were 3 investors who made all of their investments together. It wasn't just Charlie and Warren. There was a third guy named Rick Guerin. Several years ago, a hedge fund manager named Monish Pabrai had dinner with Buffett, and he said, "What happened to Rick? He was all over the early history of Berkshire, and now he's not. What happened to this guy?" And Warren told the story, which was that Warren, Charlie, and Rick made all the same investments together. But Rick did one thing different. He invested very heavily on margin. And I think it was in the 1974 bear market, he got clobbered. Warren had saying that stopped me in the tracks. I thought it was so fascinating. He said Rick was just as smart as us, but he was in a hurry. I don't think it's an exaggeration to say that Warren and Charlie have gone through their entire lives intentionally at 70% of their potential. They could have been levered. They could have gone into debt and earned higher returns, but they willingly operated below their potential because they were more focused on endurance. What I would say is it's not necessarily endurance, it's more on resiliency. And that's what I look at. I look at resiliency in my life. My investments are creating more resiliency in my life. I don't need to invest to become ultra wealthy. I don't need hundreds of millions or billions of dollars. All I want to do is I want to protect my freedom, my time, and that's my resiliency. I want resiliency to protect my time and my freedom. So that's why I invest. And I always keep that in mind. I don't need a Ferrari. I don't need, in fact, I don't even want that stuff, guys. I love the rotaries. I love the cheaper cars and just ragging living on the edge of that RPM, ragging every single little pony out of that thing that I can get at the ragged edge. And it's not as fun sometimes with higher horsepower cars because you just don't get that feeling. So I do everything for resiliency. This is the longest inversion since 1929. It won't end well. This is the yield curve, and you can see the yield curve in the recessions after these yield curves uninvert and come back up. Recession, recession. This one barely inverted, but recession, recession. They're all recessions after they inverted. Now we're inverted here, and we could come up here at any second and potentially um, have a recession or a slowdown. The difficult part is, what is this? If it is inflationary, the recession, how is that going to impact some of these sectors? I think it's going to be a difficult call. We don't have a lot of history where we've got these massive inflationary recessions. Back here, this was a depression. This was a deflation. Another deflation was 2008. That was a deflation, not a inflationary recession or slowdown. So this could look a little bit different. I know some people say that these were inflationary recessions. They were and they weren't because we pulled back in the housing starts and we were oversupplied in housing in 70, 73, 74, and 1980 every single time. So the housing market drove those recessions, and we're not there yet. I mean, obviously we could get there, but this isn't a real estate driven recession necessarily. Investment wisdom, Howard Marks, he says, when I was a boy, there was a popular saying, don't just sit there, do something. But for investing, I'd invert it. Don't just do something, sit there. Develop the mindset that you don't make money on what you buy and sell. You make money on what you hold, says Howard Marks. And that's where the patience comes into play. I mean, if you read all of these guys' quotes and you read a lot of their books, you can really boil it down to like a couple of things that they really look at. And I'll try to summarize it off the top of my head. Don't go after stuff that you don't understand and that changes quickly. Go after the boring stuff where it just continues to increase at some percent growth. So those are the companies that he's looked at: insurance companies, financial companies, and food products, stuff like that. Look for asymmetry in value. Asymmetry is where you get much larger returns than the downside. Asymmetry is where Warren Buffett and a lot of these guys have gotten rich. The only way that they got that wealthy is because of time. So they found asymmetry and then they let it compound for God loads of years. That's how they made all their money. So they didn't go after something that changed quickly. It was boring, didn't change, that could grow. Then they took a whole bunch of time, found huge asymmetry where they bought the value and then waited for that return to materialize. And that's really all it is. It's those three things: time and patience, asymmetry, and boring companies that you understand, and you have to wait for the symmetry to basically materialize. That is it. Long-term global inflation chart. What happened in 1971 where it just went straight up? We went off the gold standard. Pretty obvious there. And this is what we are experiencing today: the dollar getting clobbered. Just a heads up, energy aspects in Goldman revised lower apparent Chinese oil demand. Crude imports for August were down 1 million barrels per day year over year, and onshore crude inventories are flat MTD. This is the most obvious signal that China's demand growth is disappointing. And this is what they've got for demand. As you can see, it's coming on down, and this is what they've got projecting going forward. And then we've got the oil inventories just kind of, it's on the lower end, but we're not way down here drawing huge amounts. It's been going sideways for draws. Just an FYI for China oil inventories and demand. This is from Grady. He says the ratio silver miners versus silver shows a very nice setup now. And we've got basically this inverted shoulder head shoulder potentially and a potential breakout for SILJ versus SLV. This is the false breakdown. This is your slingshot move. Hey, you got the slingshot move. You must be listening to us. Where it pulls you down and then slingshots you higher. So this is the around the apex move that he calls it. And this is where he purchased. And yeah, we've been purchasing silver and gold. Some of the, I mean, just an FYI, guys, some of the speculative gold companies, I just crossed over 100%, a few of them, multiples over 100% in my speculative positions that I've been accumulating. And I'm hoping that I can get at least 4 or 5 well into multi-100%, hopefully a 10-bagger by the end of this uninversion of the yield curve, lowering of rates, and the big move in gold and silver. Here's gold, and this is the reason why I think I could potentially get those big returns. Gold has historical breakout versus the U.S. Consumer Price Index in the making. With only 2 days to monthly close, it's very likely a very bullish chart for precious metals. The inflation-adjusted gold price breaking out like this has absolutely massive implications going forward. And those implications are going to impact the mining companies because gold's going to be outperforming inflation, and that is the mining companies' margins. So this is it. This is your opportunity. And if you want to know the companies that I'm playing it with, you can obviously sign up to the website and find out what those are. I've got producers, and they are good risk reward. They're kind of smaller to middle cap producers that I think are riding the line of risk reward to get you that big reward. And then I've got some just ridiculous speculative plays, which is basically buying lottery tickets for this big breakout here. And hopefully that also works out when the money flows into the sector. The lottery tickets. Here's Value Investing 101. Brazilian equities are currently as undervalued as they were before the secular bull market of the early 2000s. Actually, I think I already covered that one last time, so I'm going to stop it there. That's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. And that's all I've got for today. So we'll catch you next time. This is Finding Value.